The third learning objective is to prepare an operating budget. The first three components of the operating budget is shown in Exhibit 22-5. The first is the sales budget. Number 2 is inventory purchases and cost of goods sold budget. And 3 is operating expenses budget. The result of these three budgets feed into the fourth element of the operating budget, which is the budgeted income statement. The forecast of sales revenue is the cornerstone of the master budget because the level of sales affects expenses and almost all other elements of the master budget. Budgeted total sales for each product are the sales price multiplied by the expected number of units sold. This budget determines cost of goods sold for the budgeted income statement, ending inventory for the budgeted balance sheet, and purchases for the cash budget. The familiar cost of goods sold computation specifies the relations among these items. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. Beginning inventory is known from last month's balance sheet. Budgeted cost of goods sold averages a percentage of sales, and budgeted ending inventory is a computed amount. You must solve for the budgeted purchases figure. To do this, rearrange the previous equation to isolate purchases. Purchases equals cost of goods sold plus ending inventory minus beginning inventory. Companies should have the minimum amount of inventory to be sure the company balances providing cost of goods sold to customers with turning over or selling the inventory efficiently. Keeping inventory at a minimum level that meets these needs helps reduce inventory storage costs, insurance costs, and warehousing costs, and reduces the potential for inventory to become obsolete or not sellable. This exhibit shows Greg's inventory purchases and cost of goods sold budget. Trace the total budgeted costs of goods sold from Exhibit 22-8 of $168,000 to the budgeted income statement in Exhibit 22-10. We will use the budgeted inventory and purchases amounts later. 70% cost of goods sold figure uses sales budget created earlier. The desired ending inventory is derived from company policies, and desired ending inventory becomes beginning inventory for the next period. That's the month, quarter, or year. After projecting sales revenue and cost of goods sold, the operating expenses budget is calculated. The operating budget with the sales budget and cost of goods sold budget is then used to produce the budgeted income statement that projects operating income for the period. The operating expense budget shows estimated expenses for the period. Some expenses are fixed, like rent. Others are variable, like sales commission. This exhibit shows the operating expenses budget. Study each expense to make sure you know how it is computed. For example, sales commission and miscellaneous expenses fluctuate with sales. They're variable. Salary, rent, depreciation, and insurance are the same each month. They're fixed. Review the sales budget and inventory purchases and cost of goods sold budget for Greg's Tunes. This exercise reviews preparation of an operating budget. Grippers sells its rock climbing shoes worldwide. Grippers expects to sell 8,500 pairs of shoes for $180 each in January, and 3,500 pairs of shoes for for $100 and $90 each in February. All sales are cash only. We're to prepare a sales budget. This exercise focuses on preparing an operating budget. In our results from the previous information, use the previous information and the sales budget to prepare Gripper's inventory, purchases, and cost of goods sold budget for January and February.